Hi, everyone. This is Maheen, and welcome to the Canadian SME Small Business Podcast. Today, we're exploring the strategic side of insurance for the real estate sector. In 2026, the insurance market is shifting, and for property owners and investors, this represents a massive opportunity to renegotiate terms and secure better protection. Joining us is Sarah Thompson, the National Practice Leader, Real Estate Canada, and Chief Marketing Officer at Hub Coastal Region. With over 20 years of experience in holding both FCIP and CRM designations, Sarah is an expert in risk management and insurance operations. She's here to explain how real estate professionals can use current market cycles to their advantage. And so, without a further ado, let's dive in and welcome Sarah. Sarah, it's a pleasure having you on the show today. Thank you so much for joining. How are you?
I'm great. Thank you so much for having me. I appreciate the opportunity.
Of course, very pleased to have you with us this afternoon. Now, Sarah, many real estate investors have spent years dealing with a hard market, but you've noted that we are now entering a softening phase where carriers are competing for business. Let's really understand the soft market. Tell us, what does a soft insurance market mean for real estate investors?
Yeah, it's a great question, and you're right. We are headed into a soft market, which basically means that insurers are now competing more aggressively for business. So they have capacity, which means that they're more willing to write real estate and other risks. And competition puts downward pressure on pricing. So for investors, it's a great opportunity for renegotiating those coverages. So you could see rate reductions, broader coverage terms, and improved deductible structures, particularly on well-maintained assets. But soft markets don't last forever. So it's definitely a time to take advantage and come to the table prepared.
Hmm. That is a great starting point, and it helps us realize that premiums are more negotiable and underwriters have more flexibility in the first step for an investor to take back control of their costs. Now, Sarah, let's explore common insurance mistakes that cost property owners. What common mistakes do property owners make with insurance?
Yeah, a few things come up kind of consistently. The first is underinsurance. So, especially on replacement cost. Construction costs, as we all know, kind of continue to creep up, and a lot of owners haven't kept pace with those values. So, if you have a total or even a partial loss, and your insurance is, 20% the actual cost to rebuild, you're absorbing that gap personally. So, reconstruction always costs more than building new. There are demolition costs, upgrades, and bylaws all to consider. So definitely reconstruction is the first. Second, and we see this a lot in multifamily residential, where people don't understand that what their policy actually covers versus what sits with the condo corporation or the unit owner. So those gaps can be costly when a claim occurs. And then finally, I think the third thing that owners treat their renewal as an admin task instead of a strategic conversation. So your insurance broker should be part of that advisory committee, similar to your lawyer or your accountant. You should be talking to your broker about what plans you have. Are you acquiring a new asset? Are you doing renovations or upgrades, selling or converting an asset? Talking about what's changing will really help when negotiating your insurance. So reviewing your loss history and flagging any improvements that were made to the property.
Right. No, avoiding these common pitfalls really would ensure that we aren't just paying for a policy, but actually protecting the equity that we've built in our properties. Now, Sarah, let's look at how proactive risk management keeps premiums under control. Please tell us, how can risk management improve insurability and reduce costs?
Yeah, insurers price for uncertainty. So the more that you can demonstrate that you're managing the risk proactively, the more favorably they'll look at your portfolio. So that means things like regular, building condition assessments, documented maintenance programs, updating, those main services, electrical, plumbing, and proper vacancy protocols and security systems. So it means having a solid claims history or loss history, and being able to explain when a claims happens that you've done something to prevent reoccurrence. For larger portfolios, we're seeing investors benefit from structured risk reports. So essentially, a risk assessment that is a package that goes to the market and then shows underwriters your risk quality. So that changes the conversation from, just an insurance policy to really, why would you not want to write this account? And it can really make the difference when the market shifts back into a hard cycle.
Right, right. Now, implementing a strong risk management and framework not only protects our assets, but it gives us significant leverage during price negotiations. And to all the property owners and investors that are watching in 2026, you cannot afford to treat your insurance as a set it, forget it expense. With the marketing, with the market softening, the window is quite open to push for better property valuations and really lower deductibles. So, if don't please don't wait for your renewal notice to show up in the mail. Just start the conversations now, and reach to Sarah, at Hub International, and be proactive is what I would say. But Sarah, now let's explore improving coverage terms in a softening market. What coverage improvements should investors negotiate now?
Yeah, you're absolutely right. Like soft market pricing is not the only lever. This is the time that smart real estate investors are using the environment to negotiate better terms overall. So that means, broadening coverage, improving deductibles, specifically when you're looking at cat perils or natural catastrophe perils. So things like earthquake, hail, flood. These are the times to really look at those deductibles and coverage limits and make sure that you're adequately protected. The other area is on business income. So, this is one of the most underinsured parts of real estate or really any business owner policy. Loss of rental income coverage is really only as good as the indemnity period behind it. So, most owners, what they don't realize is that reconstruction takes a lot longer on a major loss than new construction. And often, the building has to be partially demolished before you can start rebuilding. So, you know, a basic policy will come with a 12-month indemnity. That's never long enough during a major loss to rebuild. Even 18 months is better, but it can take quite a long time to get building permits, to get engineering reports done. And by that time, tenants have moved on and found a different place to go. So we really recommend minimum of 24 months, especially for, any multi-family residential assets. And then even longer, if you have complex commercial or mixed use buildings. So get that right while, carriers are competitive, while rates are coming down, and that will definitely set you up well for the long run. And finally, the other area I think a lot of probably real estate investors aren't thinking about is cyber. And this one, real estate transactions involve significant dollar amounts moving online. And social engineering fraud is a real and growing threat in this space. This is where a fraudster will impersonate a vendor, a lawyer, or a property manager to redirect the funds transfer, the wire transfer. It can happen to sophisticated investors, law firms, we've seen, and a standard commercial policy doesn't cover that. So important that you need a standalone cyber cover or a crime endorsement that specifically covers funds transfer fraud and social engineering. And in a soft market, and the market is soft for cyber as well, that coverage is now more accessible. So it's a good time to add that into your coverage.
And using this window to lock in better terms and conditions provides a safety net that will remain even when the market eventually hardens again. So thank you for sharing how do we enhance our coverage terms, Sarah. Now finally, let's look at preparing effectively for policy renewal. What should owners do before renewing their policy?
Yeah, I mean, I mentioned it before, like don't treat it as an admin task, right? So start 90 days out, not 30. And here are kind of the things that I would put on that checklist. First, we talked about it, review those replacement cost valuations, get a reconstruction appraisal, not a market appraisal. Those are two very different things. If you haven't done one in the last 2 years, that's a must. Pull your claims history and understand the narrative behind it. So if you've had a frequency of losses, what are you doing to mitigate those losses? And document any capital improvements or risk mitigation work that you've done. Those are really important. Insurance carriers use those for rating and use those for overall risk assessment. So those are important things to get ahead of. Next, making sure that those rent roll and business income figures are current. Take a hard look at those indemnity periods, and then ask yourself honestly, if I had a major fire today, how long would it realistically take to get back to full occupancy? The other thing is maybe if you're sitting on an older asset, you may not want to rebuild. You might use that for redevelopment. So what does that do to change the coverage that you're putting in place? You might not need a full broad form replacement cost policy. You might need reduced cover there to switch that. So some things to talk about for sure. And then also, we just talked about it, cyber coverage. So if you don't have a cyber policy in place that covers social engineering and funds transfer fraud, those are typically sublimits on a cyber policy. So important to take a look at those. Yeah, real estate investors are definitely a target because of that large transaction, time sensitive. That's exactly what those cyber frauds are looking for. And typically it's not an if, it's a when with cyber. So it's probably a more frequent type of loss that we're seeing than even property risk. And then finally, brief your broker on anything that's changed: new tenants, renovations, a change in occupancy, and any incidents that didn't result in a claim. Those are things that your broker will want to know. Now is the time to collect that information because really, like, data is king. So the more information that we have about your overall risk profile, the better picture an underwriter will get of the overall exposure, and will get you the best term. So if they don't have the information, they think worst case scenario. If they have the information, then they can model and rate for that appropriately.
Starting that renewal process early with a detailed update on property improvements is quite the key to securing the most competitive rates. This was a great conversation, Sarah. Thank you so much for walking us through this. And now that we're wrapping up, what advice would you give to investors that are concerned about rising risks and costs?
Yeah, I think the biggest thing is, like, don't wait for the market to work in your favor. Start building that risk profile now. Now is the time to, improve your coverage terms, improve your rates. Insurance carriers have memories. They see that same submission again and again. So the accounts that get the best terms in the market are the ones that show up organized with good data, with good maintenance records, and a broker that knows how to present them.
Mhm. That is a great reminder that the market cycle is quite a tool that we can use if we have the right strategy in place. But thank you so much, Sarah, for being on the show with us and for sharing such great insights. Thank you.
Thank you.
And listeners, I was Sarah Thompson from Hub International, a masterclass in market cycles, property risk management, and how real estate investors can win in a softening insurance market. Thank you for tuning into the podcast. Please be sure to subscribe and visit CanadianSME.ca for more resources. To learn more about how we're supporting the ecosystem, please visit Canadian SME Small Business Foundation at smbfoundation.ca. And before we leave, a special shout out to UPS and ADP for their ongoing commitment to empowering small businesses across Canada. Please keep moving forward, and we'll see you in the next one.